Well, current cost accounting is a method that broke away from the more traditional approach of using historical cost as the basis of measurement. So what CCA did was to introduce the idea of replacement cost as the proper value of an asset. So the replacement cost is the price you would pay to directly replace an asset that you already have. So this is fine if you have an asset that can be directly replaced by something that's new. We call this often the entry price or purchase price. So the idea behind this is the market is telling you what the value of your asset is, because the market will sell it to you for that value. We still accumulate depreciation on this, but the depreciation is based on the current replacement cost, not the historical cost. So what does this mean? We become aware of two different kinds of profit. There's the traditional profit or the operating profit, which is the surplus you make when your earnings are surplus to your expenses during your regular trading, through your regular operations. But then we can also make profit through holding gains. In other words, gains made in the value of assets simply by holding them over time. This opened up, consequently, more thinking about what is capital. Now, the capital that we're more familiar with is the financial capital maintenance perspective, where profit is earned if the net asset value at the end of the period exceeds the value at the start of the period. So you've earned a profit if your assets are worth more at the end of the reporting period than they were at the start. And this is the perspective that's really entrenched in our accounting standards. The physical capital maintenance approach, however, is quite different. This says that a well-run business should, at the very least, be just as capable of operating at the end as it should at the start. So managers need to, as their first priority, to maintain their level of operations. So that could mean maintenance of your assets, updating assets, and so on. So you've got to keep the value of your assets current. So what this means is that if the value of the asset improves at the end of the period, then this is really, under the physical capital approach, this would be made, the difference wouldn't be booked as straight profit, it would be put in a capital reserve. So that's what this slide means. The financial capital maintenance perspective is what we are familiar with, whereas the physical capital maintenance would do a capital adjustment. So CCA gave us a more detailed concept of profit due to its idea of separating holding gains and losses. But again, there were problems with the use of replacement cost as a proxy for value. Why is that an effective proxy for value, you ask? The answer is not readily available. Replacement cost is also quite different to the value you would receive if you'd sold the asset. So again, it's not clear why the price to buy in a replacement should be your value. And it's not clear how you would use this method if there was no direct replacement for that asset. So that's the quick tour of current cost accounting. And the next one we're going to look at is continuously contemporary accounting, where we move quite radically into exit price valuations. So stick around for that. I hope you enjoy it. Bye for now.